Good afternoon, everybody, and welcome to the LendIt Fintech Weekly News Show. My name is Peter Renton. I'm chairman and co-founder of LendIt Fintech, here with my good friend and colleague, Todd Anderson. How are you doing, Todd?
I am good, Peter. How are you?
Doing great. And we have a special guest today, the esteemed Ron Shevlin from Cornerstone Advisors. How are you doing, Ron?
Oh, I'm doing great. Good to be with you guys again.
Yeah, likewise.
Good to have you back.
Yep. So let's get right into it because we've got a busy week of news, and I want to get started with actually something from Friday of last week that broke the Google story. The Googleplex is no longer. Really interesting. I know you got something out really quickly on that, Ron. So why don't you just tee us up and tell us a little bit about what you found.
Yeah, well, first, let me give you like the little secret, because somebody had emailed me and said, how did you get an article out so quickly?
I was wondering the same thing.
And the reality is that I had that article written months ago, ready for the release. I was waiting for them to release it when I was going to publish that, and then they killed it.
Right.
So all I had to do was really change a little bit of the intro of my story to, instead of, hey, today Google released its new Googleplex, today it killed it, and here's what it could have been. So I was kind of a little bit bummed, but here's the story. It's coming up on 2 years ago that Google had announced it was going to launch a checking account and do it not directly to consumers, but do it through financial institutions. Mm-hmm. And I thought it was kind of a really good strategy. The big tech companies don't want to be regulated as a financial provider. How would they have done it? They would have had to do it like, a Chime or any other challenger bank and get in the bank. But they want to be a vendor to banks. They've got the cloud services, they've got AI-based lending tools. They see themselves as a provider of services to financial services, not a competitor. And so it was a very innovative product on paper, at least, mm-hmm. and at least from what they had announced and from some of the screenshots, some really interesting things about how it was integrated with Google Pay. And ultimately, I thought, man, this could be really cool in terms of how they might integrate a checking account into the browser altogether. But they announced it would come out in 2020. Then late last year, they announced it was going to be more like Q3 of this year. And when Q3 came and went, it was funny. Earlier in the week, I'd actually emailed my press contact at Google and said, hey, any updates on the product? And didn't hear anything from them. And I probably could have looked really smart had I gone out to Twitter and LinkedIn middle of last week and said, hey, I think something's up with Google, and I don't think they're going to be launching this thing. Imagine how good that would have sounded 2 days before they actually killed it. But ultimately, I think there's one thing for sure that killed it, and one thing that I'm not so sure, but I'm speculating about. And the one thing I'm pretty sure that really killed it was the lack of internal sponsorship at the executive level. Was it Caesar Sengupta? Is that his last name? I'm sorry if I'm getting that wrong, but Caesar's definitely his first name, who was running Google Pay back in 2019, 2020, was really the champion of this product. And when he left Google earlier this year, I think that left a really big hole. There were some reports a few weeks ago in mostly the Apple Mac related publications, because they just love to bash Google. And they were bashing Google for people, I guess they were experiencing some personnel defections out of the Google Pay division, and that was probably another sign that something was wrong there. And so I think ultimately, it's a pretty good bet that this got killed because of lack of internal sponsorship. Mm-hmm. But I think there's a second potential factor that could have played into this, and of course, Google is very big in the cloud, and that's a different division from an organizational perspective at Google. The Plex product was part of the Google Pay group. The Google Cloud is obviously its own division. And there seemed to be a couple comments that suggested that perhaps they were getting some pressure from some of their big either customers or prospects on the Google Cloud side, saying, well, why are you guys looking for us to do more business with you on the cloud side when you're competing with us on the checking account side? That could have been some factor in it. I think that's all speculation, but I think it's a pretty good bet that the first one around lack of executive sponsorship was, the real nail in the coffin.
Mm-hmm. Mm-hmm. Yeah, I think, well, the interesting thing that when I was doing some research earlier today, and those two executives that were really the internal champions. You quoted the Business Insider article in your piece. Felix Lin and Siva Sengupta. They've both gone on and started a new venture now, and it's there's nothing to it. They just got like a holding, just a splash page up, but financial services innovation is what it's all about. So really interesting to see. I mean, to me, is this this is just, I think, huge news. Is this, are tech companies really going to be, is this unique to Google, or is this something that other tech companies are going to have to rethink? Because obviously Apple is different. It doesn't sell cloud services like Google, but it does have a browser. But then you've also got Amazon, of course, that is the biggest player in cloud services. So what's it all mean for the future of big tech and financial services?
Yeah, I don't think you can lump them all together into a single group, to tell you the truth. I think there's a real dichotomy between Amazon and Google's approach and Apple versus Apple and Facebook. Apple and Facebook seem to really be taking a direct-to-consumer, stick it in your face to financial institutions. We don't care about you. We're going to make all our money that we can. And witness the recent news that banks are complaining to Visa about the Apple Pay fees on recurring payments and so forth. And obviously, they've always taken a cut of the overall interchange and fees on Apple Pay products. And Facebook too, with its Diem or whatever they call that stuff
Novi.
today.
It's Novi now.
Novi.
Yeah, and so they're going their own way. But when you look at Google and Amazon, it's a bit different. A couple of years ago, Amazon made news when it announced that it had issued $1 billion worth of merchant cash advances in that particular year, and the press, of course, jumps all over that, saying, "Oh, look, Amazon's getting into financial services. They're going to put banks out of business." But a couple of years later, what did Amazon do? It partnered with Marcus out of Goldman Sachs to not only provide merchant cash advances, but to provide small business loans to the merchants. And at the time, they, quote, leaked a wireframe of a broader marketplace that it was going to offer. I think both Amazon and Google see themselves as more platforms and ultimately providers of technology to financial services firms versus competing with them, whereas Apple and Facebook seem to be sticking their middle fingers up at the financial institutions and saying, we're coming after you, we're going after it ourselves. So I think it's a little unfair to just whitewash everything with the big tech firm. I think there's some real differences. But ultimately, I'll tell you guys, I don't think that it was regulatory issues or compliance things that killed this product. I think it was simply internal politics and internal support.
Mm-hmm. The other piece of it, the unfortunate piece, is some of those partners that they were partnering with who were kind of caught way by surprise. You would have thought that at least they would have kind of reached out to them and said, "Hey, this is coming," and it seemed, especially reading your piece, that they were totally caught by surprise. Someone like BM Technologies and others that are, and this would have potentially been a huge boom for them compared to, say a JP Morgan or a Bank of America, who already, has the title of arguably the largest bank in the US. Some smaller player connects with Google, and all of a sudden it could be a game changer for their bank.
Yeah, I got to tell you guys, I was surprised that the partners were surprised. And in fact, I think it was BM Technologies, what we used to be called Bank Mobile. I think they actually made a statement, maybe a week or so before, expressing, their expectation that this was still coming. I'm a little surprised because, if you're one of their partners and you're told, yeah, we're going to launch this in Q3, and around Q2, there's no word, or they're stringing them along. I mean, at some point, you got to look up and go, something's wrong here. Even if, and I'm sure they're under some real, tight contractual arrangements around what they can publicly say. Because I know that I actually interviewed a whole bunch of the partners last year. I said, "What have you seen? What can you tell me?" They're like, "Nothing. We can't tell you anything."
I remember that. Yeah.
So I'm sure that they were under some strict contractual guidelines. But come on, I mean, these are banks and credit unions that deal with tech vendors all the time. Who tell them about their roadmaps that never come to fruition, and so it couldn't have come as a surprise, although it did for some of them.
Yeah. Anyway, we need to move on. We've got other stories we want to cover this week. We saw a return of postal banking, which it just seems to be the idea that doesn't die. I mean, there's a lot of Democrats in Congress who are really keen on this idea, and there is now a pilot in place in 4 cities in this country. It's part. You can't really call it postal banking. It's more like postal check cashing right now, because it's just really one product, cashing a check. The check has to be under $500 as well in 4 different cities. But I feel like the postal
you would
service,
think, like, I see this, and it's like you would think that the regulators would get together with all these fintech companies and even some of the smaller banks and say, how can we come up with something that makes more sense than going to the post office?
right?
Like, to me, I just don't. I don't know how they came up with. I know the postal banking idea has been out there for a while, but I don't know, with everything happening in financial services these days in fintech, why they would go that route instead of maybe a consortium of fintechs or community banks and fintechs. And to me, the postal banking idea just doesn't make any sense.
Well,
Ron,
I'll weigh in here too. First of all, this is politics. It's not even banking. And that's what makes this a really touchy conversation, because I don't want to really, offend anybody and get into politics. But, from a political perspective, it was actually a fairly smart move. Although, for the record, I'm really not in favor of this idea in the least bit. But from a political perspective, it was actually a pretty smart move, guys, because what the post office is doing right now is nothing other than what they've already done, issuing these prepaid cards. And so, they're just doing it now with a different source of funds, being third-party checks.
Right.
But I think what they're doing is smart from a political perspective, because they're kind of inching their way into this. They'll say, this was our pilot test. Look how successful it was. Therefore, we should expand, versus trying to create, the postal bank all together, all in one. So it's an interesting move from a political perspective. But ultimately, I think there's so much politics here. I tweeted yesterday, I said, I still haven't seen any data that says that consumers actually want this.
Right.
And the response I got back from people was, well, this is what the pilot is for. In fact, even the chief innovation officer of the FDIC got on my case saying, well, let's see what the data, turns up. And my take is that because we're talking politics here, that whatever data comes out will be spun to be positive for postal banking. So we'll see where this goes, but I think the bank lobby is going to be pretty strong on this one.
I also don't. And you make a good point about the politic angle. I do think, though, that it's shown time and time again that the current politicians don't truly understand fintech and the banking and financial system. And I think it would also suit them, if going the other direction, to better understand how some of these fintech and financial services firms operate versus a postal banking. But that's obviously a larger, different discussion. But that was kind of part of my thinking behind it too. It just seems like they're just not up to the standard we need them to be in terms of understanding how the financial system works and how all these different pieces play with each other in the financial system.
Right. And they're not talking opening bank accounts. I mean, they're not yet anyway.
Yeah.
They're just talking about doing things they pretty much, as Ron said, pretty much already do. It's just a slight tweak. But anyway, let's move on. Article in American Banker this week that I thought was interesting, and I think that they may have, about buy now, pay later. We talk about buy now, pay later every single week on this show, just because there's news every single week. It feels like for the last 3 months, and this particular piece talking about one of the driving factors, and I don't think it's actually a huge factor, to be honest, but that was reporting on the fact that card issuers clamped down on new cards at the start of the pandemic. I mean, and they also dropped people's credit lines, and this drove people away from credit cards. People got annoyed and they wanted the personalization and the whole controlling of your spending. But I think this is one factor. The consumer has basically made it pretty clear that they like buy now, pay later. They like the control of having 4 equal payments or a short term loan. But what do you guys think? Do you think this was the credit card issuers kind of shot themselves in the foot here?
Well, I think I don't want to sound critical of American bankers, not that they call me every day anymore, but so maybe they won't listen and they won't hear this, but I think they were kind of stretching for a story here, to be honest with you. It's kind of like saying that the current, the traditional lenders fueled the fintech lending boom post 2008 when they clamped down on bad on poor credit risks. Of course, people are going to go, if they're not getting credit from where they've gotten it before, they're going to find it from somewhere else. But that's not news. It's not newsworthy to kind of mention that. I actually thought that the angle was going to be that the credit issuers help fuel the buy now, pay later boom by letting people pay their buy now, pay later bills with their credit cards, which of course, after a while, Capital One kind of clamped down on and said, we're not doing that anymore. So, that in and of itself isn't real newsworthy. And I will probably, get skewered for this one. I still think that this buy now, pay later thing is an outsized trend that's getting way too much press and attention, and will go away sometime in the future.
Interesting.
When this kind of dies out a little bit, until or unless I think the real opportunity for buy now, pay later is not as a post payment, but as a mechanism to help drive sales in the first place. And what's funny is if you go back 60, 70 years now, wasn't that the whole premise behind credit cards? Was that it helped merchants, create or enable them to have larger transaction sizes because it would enable people to buy things that they didn't have to pay for right away. So until that gets really proven out that it's really driving the merchants' top and bottom lines, I still think this is a little bit of an outsized story.
Okay. I mean, there's some early data that shows it's definitely helping with sales, but I also think the other angle to it is that, there's going to be bad outcomes here, and the regulators are going to get involved, and the market's going to then be really defined. I don't think it's really been defined yet. I think there's a lot of interesting things happening. I think some of it's good in the sense that we figure out what consumers want and how their buying patterns are, and then there'll be some bad outcomes. Then regulation will come in and it'll kind of begin to set where the market is and maybe redefine what credit cards mean, maybe not. But I still think there's so much more left to find out about the space. I think it's going to stay around for a while. I just don't know where it's going to go once some bad things happen and regulators begin really digging into what some of this means.
Well, I'll agree that I think it's certainly overhyped. There's no question. I think some of the companies in the space are well and truly overvalued as well. But I still think I'm with Todd that I think it's going to be a payment mechanism for the next 50 years. But let's move on. Facebook. I wanted to talk about Facebook. They went down on Monday for 6+ hours, and that's really neither here nor there as far as I'm concerned. But what I think is interesting is the Novi digital payments initiative that was called DM and now it's called Novi. That went down as well. I mean, obviously we talked all of Facebook. All of Facebook's properties went down, but I was just wondering. Thing that I thought was interesting is if this has happened in 3 years' time and Novi has got traction and there's people using it, and it's obviously got a massive user base, so there could be literally millions of transactions a day going through this thing, and it goes down for 6 hours. That's like Visa and MasterCard don't go down for 6 hours. So I just wanted, to me, this is a story that is another kind of negative, shall we say, against Facebook's payments initiatives. What do you guys think?
Todd, I'll let you go first. I don't want to dominate here.
No, I mean, I agree. And it's another piece of the crypto, the wallet, the coin story, in the sense that, before they're fully regulated, they're not helping themselves out. I mean, it just seems like some of these mistakes keep on happening. And while there's lots of people annoyed at the SEC, and personally, I think the SEC is not interacting enough with some of these companies to understand maybe where the boundaries are. They're also not helping themselves in any way when you have issues like this, or when certain companies maybe skewer the SEC. It's like the only way it really is going to stay is if it intermingles and becomes a part of the traditional financial system. Because if it doesn't, then it's still going to be this little conglomerate of really hardcore people, but that's such a small minority than getting into the regular financial system. And I think that's where the focus should be, and it just still doesn't seem like it's that is the focus right now. And I think there's real problems in the space going forward.
Yeah, I tend to agree with you, Todd. And as much as I'd like to bash Facebook, I don't necessarily see this necessarily as just a Facebook problem. It's really a problem from a mobile payments perspective in general, which is there needs to be better, I'll call them offline mechanisms, but they're not non-computing mechanisms. It's not like we're talking about, you got to start transcribing your transactions with paper and pencil. But there's got to be a way to have an offline mechanism for tracking and capturing the transactions if the network goes down, or if something like that goes down. And I don't think that Facebook apparently doesn't have it in place yet. But I think it's a general problem, potential problem for just mobile payments in general, that there needs to be some sort of better backup system in case of network failure.
Mm-hmm. Yep, for sure. Okay, I want to move on to US Bank. This is, I think, the largest bank, the number 5 bank in the country, the largest bank that is going to offer a Bitcoin custody service. It's in partnership with NYDIG. That seems to be getting a lot of these partnerships closed in recent weeks and months. I feel like it's another kind of mainstreaming, shall we say, of crypto, where I read the article, CNBC broke the story, and they you read there where basically US Bank went out to their big institutional clients and they said, yep, we want you to do this. So another big bank taking on Bitcoin.
Yeah, I'll jump in. I love this. Love it. I don't think US Bank gets enough credit for being as innovative over the past couple of years as it has been. Give Dom Ventura there a lot of credit, quietly building a lot of innovative capabilities there. I like it for a couple of reasons. I actually did some consumer research at the end of last year, and I asked consumers who had already was holding some form of cryptocurrency, whether it was Bitcoin, Ethereum, or whatever, and asked, if you could get crypto from your bank, how interested would you be in it? And a huge percentage of consumers who already had crypto were interested in doing so. And among consumers who expressed an interest in getting crypto at some point in the next year or two, said that they'd be very interested in getting it from their banks. It's interesting when I talk to banks and share that data. This is like the new religious argument in banking. It used to be about bank branches, whether they were dead or alive. And now the big argument is, should we get into crypto or not? Mm-hmm. And it's interesting that, a lot of the detractors or naysayers, point to the volatility in crypto as a reason why they shouldn't get into it, to which I point to a number of stocks that have declined 80 or 90% in the past year. I said, you don't stop your customers from buying those. You don't stop your customers from using your debit card to purchase alcohol or cigarettes or other things that aren't good for them. So why are you going to stop them from buying something that they want? And they're saying they want this from you. So I give US Bank a lot of credit for listening to consumers, what they want, to their customer base, for getting out there, being on the leading edge of this.
I mean, I'm not the big regulatory guy personally, but I think, I mean, the banks, I don't know why they wouldn't be jumping into this. They can essentially help write these rules with Congress and the SEC, the FDIC. I mean, everyone they intermingle with, because the bank lobby is super powerful, and they can help get this along in the way that would be safest for them, essentially. And it seems like it's, they're not jumping in as much as maybe they should. I agree on the U.S. Bank point, especially. The one thing about them is that, unlike other banks, they don't tout their stuff a lot. They kind of just under the radar, and they're, constantly, doing good and interesting things. But they're not as hungry, I guess, for that PR press, maybe some other banks. But I think banks could really help define where the crypto rules are if they wanted to. And I think maybe they will. I just, they haven't all jumped in just yet.
Right. Well, speaking of defining crypto rules, we did have the SEC chairman, Gary Gensler, testify in front of the House Committee on Financial Services this week. Well, it was a pretty wide-ranging testimony. I mean, Crowdfund Insider wrote a good piece. Andrew Dix, or JD Alloy, wrote a good piece about it. Basically, they were trying to get him to declare whether or not different tokens were securities, and he was hedging his bets on that. But he also had a lot to say about stable coins and about how they're using it to avoid AML rules and tax rules. So it was a pretty interesting. I don't know if you caught any of that, but what do you any thoughts on the SEC chairman?
I'll pass on that one. I'm not too deep in that one. Todd?
It feels like there's a lot of standing your own ground right now on kind of both sides. And I think the only way it gets, and granted, it's not necessarily the regulator's job to go out and seek these companies. I think some, in some administrations and the people they put in certain places did it more. But really, I think the industry should be trying to knock down the door and show everyone within the SEC, within all the regulatory agencies, exactly how their businesses work, and what can we do to help write the rules? What can we do to give you more clarity? What can we do to answer any questions? And it seems like right now there's too much, especially publicly, too much fighting back and forth. And I think if I was in the crypto industry running a company, I'd be trying to talk to someone every day about my business, because there's no way it's going to eventually survive without, like I said earlier, being somewhat intermingled within the financial system.
Right. And there is the last story I want to get on today was a story in Bloomberg last night. I thought it sort of was really interesting, talking about we've seen this massive rise in fintech companies, and there's a lot of excitement and a lot of valuations are going up and money sloshing around. And we haven't seen any major failures yet in this country. And we've seen them in the UK with Wirecard and Greensill. And I feel like, what the article was basically saying is that the government is really, fintech is moving so fast. And the last 18 months have been incredibly fast as far as growth and new products and all those kinds of things. And regulators are really struggling. And now, eventually we are going to see a fintech blow up. There's no question. And then what always happens in those situations is the government tends to overreact. But the base of the point was regulators right now couldn't keep up. They couldn't have kept up. They weren't keeping up before the pandemic, and now it's even more difficult.
Well, I mean, I think they both need to try harder, personally. I mean, but it's, especially the fintech industry. I mean, there's definitely going to be a blow up. And it's probably because the company's doing something they shouldn't be doing. And the more fintech companies that are showing the regulators what they're doing, the safer that we'll all ultimately be, and the rules will be defined in a collaborative way versus, all right, well, we see you did something wrong, now we'll just clamp down this way.
Yeah, this is a messy situation, and I think you, Todd, you're kind of alluding to part of the challenge here. I'll tell you that most of the fintech companies that I talk to have directors of compliance. Are want to be regulated. They want to be part of the system. They don't. They're not looking to, do stuff that's kind of out of the boundaries. They want to be part of the system. They want to do this right. You can always point to big failures like Wirecard and Greensill, which, really more about their in lack of internal controls than it is about the lack of regulatory oversight and compliance. So, it's kind of a messy situation. I think it's interesting. I was on a panel at Money 2020 a couple of years ago with a former lawyer from the CFPB, and the question was, can regulators keep up with the pace of change in technology? I argued no. She argued yes, and it was I think the only time in my life I ever won an argument with a lawyer, because you're right. They can't keep up with the pace of change from a regulatory perspective. But I don't like the portraying of fintech as rogue players who are looking to buck the system necessarily. That's not what I see with a lot of the fintech companies that I talk to.
Right. No,
Yep,
it certainly wasn't implying that. I just it just
no, I didn't think you were implying it, but I think sometimes the press implies that.
Yes.
Yeah.
For sure. Anyway, we are out of time. That's all we have time for this week. Thank you very much, Ron, for joining us. Thank you, Todd. We'll be back same time next week, 5 p.m. Eastern time. And thanks very much for listening.
Yep.
Bye.
Thanks for having me, guys.
Yep. See ya.